CEO of Sprott US Holding. Thank you, Rick, for accepting to do this interview with me for our YMP members. As you know, I'm currently based in Montreal, but we have chapters all across the world. And we've gathered a list of questions from our members for you to give us your thoughts and opinions on it.
Well, thank you for having me. I'm a big fan of your organization.
Thank you. So first question, what is your take on the policy measures in the current context that we are witnessing? I guess pretty much everywhere, but let's just talk about the US, where is like quantitative easing, monetary stimulus, lowering interest rates.
Not surprisingly, for people who follow my work, I think the policy response has been disgusting. The US politician who expressed their intent the best was Rahm Emanuel, who said, never let a good crisis go to waste. And this, if you saw, I don't know how much Canadians have paid attention to US politics, you have your own problems. But if you saw the response in the most recent budget proposal, we fought the coronavirus by establishing extra tax breaks for real estate investors, by subsidizing, public broadcasting, by a $25 million grant to the Kennedy Center. You get the point. The policy response is all about using a crisis to favor domestic political constituencies. Always has been, always will be. I'm sure somewhere in the morass of politics in Canada and the United States, there's some government program that might accidentally do some good, but they've managed to disguise it fairly well in all of the other programs that they've proposed. The truth is that for certain aspects of the mining industry, that is the gold mining industry, what they have proposed is figuratively a gold mine, but we can get to that later.
Yeah, so I guess like on that mining aspect, what impact do you think COVID-19 might have on exploration financing?
Well, three broader comments. The first is obviously in remote communities, including remote mines and remote exploration camps, it's going to change the way we do business for a while and probably for a very long while. We've seen both camps and mines in the north shut down for very good reasons. And I suspect that this is a wake-up call for causing people who live together to live together in more healthy circumstances. So in that sense, I suspect some good will come out of the bad. With regards to funding, my experience has been that in economic liquidity crises, the sort of things that follow any broader crisis, that the aspects that get defunded first are tertiary or marginal assets. And there's certainly, unfortunately, no more marginal industry in the world than exploration. So funding for exploration, I think, will be less generous than it has been. Funding in particular for frontier and emerging markets countries, which are also, by their nature, tertiary, will be hurt. So to the extent that a young professional in mining aspiration in the near term is to engage in copper mining in Peru, they're going to have to find something else to do for a living for a little while. But make no mistake, it'll be back. This is the fourth time in my career that I've been faced with a circumstance that was going to be the end of mining for all times. And of course, that never occurs. So don't worry too much about it. Just make other plans for this year.
So I guess that ties into our next question that one of our members asked is, what does globalization look like post-COVID-19 world? And I guess that relates to mining sector as well.
I think globalization is in some near-term trouble. When I say near term, the political winds are against globalization right now. Globalization just makes too much sense. It's a form of freedom. And elites and various political constituencies hate freedom. They want protection. So in the United States, we might want to be protected from Hispanic people coming across the border, working for less money and doing a better job than we do. Canada might want to be protected from American capital, all those kinds of things. The truth is that free markets and free movement make everybody collectively richer. They just make certain well-connected political constituencies poorer. And unfortunately, I think in the near term, COVID will be an excuse. A poor economy will be an excuse. There will be many excuses to derail globalization, which is very unfortunate. My generation has been a huge beneficiary of the opening up of world trade since 1980. And your generation will be a beneficiary too when the world gets back on track. But my suspicion is that won't happen for a while. I think we're going in a direction right now that's very detrimental to freedom and very detrimental to wealth creation, unfortunately.
So then how can young professionals who are early in their career take advantage of the current situation?
Well, the fact is that a good life is coming to you almost certainly. If you look around the extractive industry, what you'll see is that all the important jobs, or almost all the important jobs, are held by people of my generation, which is to say people who are substantially past their sell-by date. The truth is that there's a major skills gap in extractive industries, all the way from the mine face to the CEO. It's interesting now, when I go to the PDAC or one of the large mining conferences, what I see is that all of the people that I came up with when I was your age running things, and I don't see any of us getting any younger. And the generation between me and you went somewhere else. So really all you have to do is manage to survive the next couple of years. And you look like you're going to do it. And truly the wind is going to be at your sails. What you also need to realize, however, is two things. The first is that extractive industries, mining in particular, are capital-intensive cyclical industries. And when you have 7 or 8 years, they are inevitably going to be followed by 3 or 4 or 5 bad years. That's the way it works. There are people like postal workers who are going to live a very different life than yours. Probably not as good, but more secure. So understand that in the mining industry, when things are really good, they're getting ready to get bad. That's the way the industry works. The boom town and the ghost town are metaphors for our industry. And so you will need to, more than people in sensible jobs, save. Because you're going to have good times and you're going to have bad times. The second thing that's going to happen to you that didn't happen to me, mercifully, is that technology is proceeding so fast now. I suspect that the half-life of your technical degree is 3 or 4 years, which is to say that you're going to need to be involved in absolutely constant improvement. People say, you know, the rock packages don't change over billions of years. Well, that's true, but your ability to analyze data and interpret data changes very rapidly. And unlike me, mercifully for the world, you're going to face a lot more competition. When I was coming into the mining industry, the whole industry looked like me. Well, not exactly like me. They look like me if you roll the clock back 40 years. Male, Caucasian. There wasn't really much competition. And the fact that there's more competition is a very good thing, because we stuffed up things pretty badly. But a young professional in mining now is going to face competition of the type that's facing me on the screen, as an example. Female. Never happened when I was your age. They're increasingly, the talent, and this is a good thing, is going to be Asian, it's going to be African, it's going to be South Asian. All of this competition means that you are going to be able to accelerate the work that you do by collaborating with a whole range of talents that didn't exist in the mining business before, using technology that my generation can't even spell. It's a wonderful future, but it's going to be, it's going to be challenging for you. Always remember, despite the technology, that ours is a capital intensive business. It's very, very, very cyclical. It will boom and it will bust. And when you're having your good years, prepare for your bad years. And when you're having your bad years, bone up on your skills. Get ready for the good years. That's just the way it's going to work.
And now, speaking of gold,
Yeah.
will the interest of gold, that whether it's physical or gold stock, you think will increase as a result of what's happening in the world?
I really, really do.
Oh, you do.
People misinterpret the role of gold in finance. Many people who have held gold are disappointed that the price of gold didn't skyrocket 3 weeks ago. The truth is that gold fulfilled its function. It was a source of liquidity. What happened 3 weeks ago is that when everybody went to cash, people sold what had a bid, and gold had a very, very, very deep bid. First of all, there were about $60 billion worth of bullion that were held in leveraged long commodity trading accounts, sometimes leveraged as much as 33 to 1. When credit becomes unavailable, that leverage unwinds and the gold gets sold. It got sold and it found a bid. Gold moves because of the policy response to a crisis. And if you've looked at the policy response in your country and mine, it's what one would expect. Bailouts for politically connected beneficiaries, stimulus. And stimulus, by the way, Bianca, if you did it or I did it, would be called counterfeiting. When Trump does it and Trudeau does it, it's called quantitative easing. It's the same thing. It's creating artificial currency units backed by nothing and throwing them into the economy. But it's something much more pernicious than that. It's also about a generation, my generation, that changed the course of the way people deal with each other, voted itself all kinds of benefits and emoluments, and we're leaving you the bill. Quantitative easing is really a forward shifting of benefits and a backward shifting of liability, which is something that you need to concern yourself with as you go forward. The third thing that, of course, happens is that interest rates, which are already artificially low, become artificially lower. So at the same time that the balance sheet of the guarantors of things like government bonds becomes worse as a consequence of deficits and debt, the rewards that accrue to savers for holding government bonds go down. Traditionally, the most important determinant in the gold price has been savers and investors' sense of the ongoing purchasing power of fiat currencies, particularly the US dollar, which is the world's reserve currency. And the policy response to this crisis has been to make the balance sheet of the US government worse, while at the same time rewarding investors in US government securities less. Let's go through the arithmetic. At the federal level in the United States now, we have $23 trillion in on-balance sheet liabilities. Maybe you're young enough to have a calculator that goes to 23 trillion, but my calculator stops after 9 zeros, doesn't go to 12 zeros. But it gets a little worse than that. In fact, that doesn't include federal and state liabilities in the United States. That's just federal. And it doesn't include off-balance sheet liabilities. Off-balance sheet liabilities are debts that aren't reflected in the bond market, but rather are entitlements, things like Medicare, Medicaid, Social Security, things like that. If you add those up just in the United States, the liabilities of the federal government exceed $130 trillion. Now, you service those, of course, by the national income, which is tax and fees, less expenditures. The problem with servicing the $130 trillion is that the national income is negative to the extent of $1.5 trillion a year. Perhaps young minds of your generation can figure out how to add a column of negative numbers and come up with a positive sum. But that wasn't taught when I did maths when I was your age. It seems to me very difficult to do. If you can't do it, what it means is that you recognize that the debt is unserviceable. And you either have a good old-fashioned default, where your generation tells my generation, you guys voted all this stuff for yourself, stuff it, you pay for it, politically fairly unpalatable, or you inflate away the net present value of the obligation, which is what my generation did in the 1970s. If that occurs, which is, I think, the most likely political outcome, it's extremely, extremely good for gold.
So then that leads us to another question that one of our members asked was, could cash requirement from investor drives gold lower for a longer period than in the current crisis we're facing?
I think there's a chance of that. I think you would do well to have your member read Nassim Taleb's book, Anti-Fragile, where he says, among other things, that predictions tell you lots about the predictor and very little about the future. So the idea is that a rational portfolio would have some gold and would also have some cash, some forms of liquidity, because the truth is that many of the circumstances that face us point to deflation. A default cycle points to deflation. The realist says that you look past the scenario to the policy response. From the politician's point of view, a market clearing event would result in people losing their house, more specifically voters losing their houses, and other voters losing their jobs. The yield to politician from deflation is low. The punishment for inflation is much less. So one would expect in a political world where there is still confidence and still savings to plunder, that the response in front of us is much more likely to be good for gold than bad for gold. But the truth is there's no certain answer.
And with mines shutting down or going into care and maintenance, what do you think is the outlook for supplies of metals and the prices of metals?
That's a great question. If you're willing to look at non-gold metals over 4 years or 5 years, but what's happening now is a very good thing. You have to get from here to there, of course. My suspicion before this virus was that worldwide we had been through a 10 or 11 year economic recovery, an anemic recovery perhaps, and also a recovery that was driven more by artificially low interest rates and liquidity than it was real global economic growth. I'm not an economist, but in my life experience, a 10-year-long recovery is very long indeed. And my suspicion was that we were going to have a good old-fashioned recession to get out of it, a 3-year or 4-year or 5-year long recession. A long, grinding, brutal, boring bear market that impacted copper, impacted nickel, impacted oil, impacted phosphate. I suspect that one of the things that will come out of the slowdown triggered by the virus will be a much sharper price decline. And if we continue to have capital markets disrupted, that will have at least 3 impacts. One will be first a deferral of sustaining capital investment, certainly a deferral of new project investment, probably disinvestment from mining. But what also happens is that markets work. The very low prices that you're starting to see, as an example, in the oil field now, in the uranium business, and I think you will see coming up fairly quickly in the copper business, will do 2 things. It will, over 2 or 3 years, reduce supplies to a market clearing level, at the same time as the extraordinary utility afforded by these commodities at cheap prices to consumers will increase demand. That's the way markets work. So the seeds of recovery are certainly being sown in the current period. Markets are very, very, very messy. They're very unpleasant. If you have a job and lose a job, one doesn't care so much about the dynamics of supply and demand as one cares about one's own circumstance. There's no way around that. But I My suspicion is that as a consequence of a very precipitous decline in metals prices and a precipitous decline, near-term decline in the fortunes of the mining industry, that the recovery will come quicker than it otherwise would have. Small solace, of course, to somebody who needs it to turn around now, but what we need isn't something that the universe cares particularly about.
And I guess on a more like general outlook, what is your take on royalty companies?
Well, the royalty business is a great business. I had the great good fortune back in 1982 to be an original shareholder in Franco, which maybe makes the royalty business seem more personal to me. But the truth is, where you don't have operating cost, you don't have sustaining capital cost, you don't have capital cost. All you have is an economic interest, provided that you don't overpay for that economic interest. It's an extraordinary business, and particularly with the larger royalty and streaming companies, where most of their portfolio is made up of tier one assets. It's difficult to overstate the benefit of a tier one asset. Tier one assets always surprise you, and their surprises are always pleasant. If you look at the case as an example of Franco-Nevada, they invariably, after a year of production, end up with more royalty reserve ounces than they started the year at, which is to say that these great big tier one deposits get bigger and better over time. The economic circumstance that we find ourselves in, where an industry that already regarded itself as undercapitalized becomes functionally uncapitalized, is also extraordinarily good for the royalty and streaming businesses. They still have access to capital and very, very, very low costs of capital, at the same time that their ability to deploy capital is suddenly better by a quantum than it was a year ago. The third thing that attracts me to, in particular, the precious metal royalty and streaming companies is the disparity in valuation between base metals cash flow and precious metals cash flow. A large copper producer that produces, let's say, 100,000 ounces of gold a year as a byproduct, is valued in the market at 4 or 5 times cash flow, the gold cash flow and the copper cash flow. If that production is sold to Franco or Wheaton, sold to a streamer, that same cash flow is valued in the market at 15 times cash flow. So you can have a circumstance where Franco or Wheaton buy the gold stream from a copper producer. You can have one transaction that lowers the cost of capital for the copper producer and is accretive on a per share basis to the shareholders of Franco or Wheaton. And these transactions where you monetize precious metals revenue streams from big base metals producers can be very large transactions. They can be billion-dollar transactions or $2 billion transactions. The ability to allocate very large amounts of money, which the royalty and streaming companies can still acquire cheaply, in transactions that benefit both the buyer and the seller, are extraordinary transactions. Ones that will take place and ones that will benefit all parties, but will benefit the shareholders of the royalty and streaming companies over the next 10 or 15 years. It's truly an astonishing situation that we find ourselves in for those guys.
So what do you look for in a company before investing in it?
Depends on the company. If I'm looking for myself or clients on behalf of investment grade companies, the biggest of the biggest, I look at really discounted net present value. The way that many people view mining companies is on a price earnings basis, which I think is illusory, because every day that you mine, your business gets smaller. So price NAV is important to me. Capital allocation decisions by the current management, if that's measurable, matter to me. The assumptions that go into management's projections matter to me. The level of general and administrative expense relative to similar peers matters to me. All of those things matter to me. As you come down the scale to the exploration business, what matters is really only two things. Three things, I guess. Intellectual capital, near-term solvency, and macro prospectivity. Too often, we'll do them in reverse order. Too often, explorationists look for small mines. And the huge risk there is that they might find one. They look for small mines because the idea is they put it in production with small capital expense, and then they grow the business with internal cash flow. Well, quite often the internal cash flow from a small mine is negative. And the management team that's pretty good at finding something finds out just how bad they are at operating things. They're very, very different skill sets. So I want to be involved in an exploration company that's looking for something big. Importantly, I want the resumes of the managers to be suited to the task at hand. You may have heard this quote from me, and I'll try and keep it clean, given your audience. When someone comes to me and says that he or she has been a success because they operated a gold mine in Archean terrain in French-speaking Quebec, and they're offering that up as the necessary expertise to look for as opposed to operate a copper-gold porphyry in tertiary volcanic secreted terrain in Spanish-speaking Peru, well, certainly both tasks involve mining. The skill sets involved in the success in the former case have no bearing on the projected outcome in the near-term base. So I want the skill sets associated with an explorer to be very, very suited to the task at hand. You find that people are just better at some things. Talent isn't ubiquitously distributed, nor is experience ubiquitously distributed. If you follow the sort of thesis, first of all, about the 10,000 hours, the amount of time necessary to become proficient at something, if you didn't spend that 10,000 hours at one thing, the truth is that you never acquired a proficiency. And while it's useful for me to do business with explorationists who have a wide field of expertise, know rock assemblages from many terrains, what I found is that people who do tertiary volcanics, who do epithermals and porphyries, tend to do better looking for, epithermal gold deposits and porphyries than people who studied in other forms of terrain. So I look very much to that. And then finally, and many of you younger viewers are going to hate me for this, but I'll say it anyway. Pareto's law works. Pareto was the Italian social scientist that sort of codified the 80-20 rule, where 20% of the population generates 80% of the utility in any sort of discipline. Understanding Pareto's law from a career or an investing standpoint involves two further realizations. The first is that it's a bell-shaped curve. And in any particular task, while 20% of the population base generates 80% of the utility, there's a different population base, a different 20% on the other lip of the performance dispersal curve that generates 80% of what I might call the aggravation. Economists would call it disutility. So the first thing you do as a job seeker or as an employer is you try and find the good 20 and associate with them and avoid the bad 20. Because luck and performance aren't allocated ubiquitously or evenly across society. The second thing is that in a task as big as mining, with a population base as big as mining, you can run either the good 20 or the bad 20, that lip, the 20% of the population, through the same performance dispersal curve, and they will aggregate in the same fashion, which is to say that 20% of the 20 will generate 80% of the 80. So 4% of the population base will generate in excess of 60% of the utility. And I would suggest that the same holds true for at least one more standard deviation. So if you look across the length and breadth of the Canadian junior sector, what you will find is that there have been people, Clive Johnson, Ross Beatty, Robert Friedland, Lucas Lundin, Bob Quartermain, who have been serially successful, who have had 5 or 6 successes under their belt. There are other people who, if you talk to across a conference room or in a lecture hall or something, seem to be completely competent and are completely competent, but they haven't delivered. Why is that? I don't know. What I do know is that the serially successful begin to benefit from a virtuous circle. Because they're successful, better people want to work for them. Their cost of capital is lower. They attract better prospects. It doesn't make any particular sense not to associate with the best of the best, particularly in bad markets where the sector is so out of favor that you can buy the best of the best with no particular discount because nobody cares about anything. At this particular point, either in your young career as an investor or in your young career as a job seeker, remember Pareto's Law.
And Rick, do you have one last piece of advice for investors, including the millennials members that we have?
Common sense, really, truly common sense. We're infected by one great and horrible thing in the mining business. They're both the same. It's hope. There's a narrative around mining. Several narratives. There's a price narrative. In other words, everything will be wonderful if the copper price is $4.50. Well, of course that's true, but the copper price isn't $4.50, so forget about it. It's common sense that really matters. In times like this, you can't buy a junior that's practiced just-in-time capital raising because they just ran out of time. Common sense is really what's attractive. For your generation, I guess 3 more things. With your skill sets, time's on your side. All of your competition is literally, not just figuratively, literally dying. We're all past our sell-by date. And there's a 35-year gap between the people who have the skills that you have and you. But remember, too, that markets work and good times will follow bad times. So you really need to prepare yourself during good times. And good times are very, very, very dangerous. I remember at your age in the 1970s going through a spectacular bull market. You won't remember, but let me tell you, the gold price went from $35 an ounce to $850 an ounce. The silver price went from $1.50 to $50. The natural gas price went from 35 cents to $3.50. Tremendous bull market. You know what I did? I confused a bull market with brains. I thought I made all this money because I was smart. And that's something that a bull market does. So to the extent that you can guard against the success that you're going to have 4 years from now, 5 years from now, 6 years from now, 7 years from now, I guarantee you'll be punished 10 or 11 years from now. So don't let the success that you enjoy in a bull market lessen your determination to continue to improve yourself competitively relative to your peers with the technology that's available to you.
Well, thank you so much, Rick. That was
pleasure.
All good answers and good advices. So we really appreciate on the behalf of our YMP members.
Well, thank you so much for the opportunity.
Thank you.
Bye-bye.